Welcome back, everyone. I hope you're enjoying your day. I just wanted to jump in with a little impromptu video. I was not planning on recording anything, but I just had to vent. I had a vent, and I don't normally do this, so I hope you make an exception this time. But this is so stupid. For lack of a better term, the market, in some cases, is so dumb. So incredibly dumb. And again, I could come up with a more flowery term, but I think dumb describes it really well. The example I want to give is the very recent earnings report of Netflix. Netflix just posted their earnings literally 15 minutes ago. And we have the results right here, at least the top and bottom line. Their earnings per share beat estimates, $2.88 versus $2.86. Their revenue missed estimates by a hair. It basically matched it, 8.16 billion versus 8.18. So these are very in line. They beat their earnings per share by a hair. They missed their revenue by a hair. The stock sold down as a result by 10%. That was the initial move in the stock. To sell off 10% of it, 10% of the market cap in 5 minutes because the company reported inline results. Now, the reasoning is because Netflix didn't hit some arbitrary number of subscribers, even though they grew their subscribers. But the subscriber count doesn't really matter all that much because they have different tiers of subscribers. Some of them make far more money than others. This is what's going on with the market. It sells off 10% right after earnings. It's recovered a little bit because investors are realizing that they're dumb selling it off that much when they actually look into the earnings. Now, think about this for a minute. Let's go ahead and jump into the actual investor report here. This is from Netflix themselves. And we go down to we can skip past the highlights. They brag about some of their films, the Outer Banks, Murder Mystery 2, some of the big hits they just recently had. We'll skip past all of that glamorous stuff. And I want to focus on this table here. This shows just the numbers. We have right here the numbers straight from Netflix. And just so you can read this table clearly, this is the most recent quarter. So it goes from left to right, and this is the forecast. I want you to look at one line here. I'm in front of it, so I'll go ahead and move myself out of the way. This is the free cash flow. Now, if you're an investor, you're investing in companies to earn cash. That's the reason you own them. And you like it when the free cash flow is large and when it's going up over time. That's typically a good thing. When the company's growing its free cash flows, investors should like that because that's the entire reason you own a stock. We look at the free cash flow line. And back in 2022, it was 800 million, 13 million, 472 million, 332 million. Last quarter, they just reported $2.11 billion in free cash flow. $2.11 billion in a single quarter. This is the 10% sell-off, a company that just posted $2.1 billion. The most free cash flow by far that they've ever posted in a single quarter. That's more free cash flow than they made all last year. Now, you might say, well, that's already baked in. That's already expected. We can go on to another part of this earnings report that I think is even more funny. We look at this part here, and this really highlights where I think investors' gut reactions on these earnings report are so often incorrect. They're so often dumb in the way that they react. This paragraph right here, Netflix, with Moody's recent upgrade, they say that we have achieved investment grade status. Now, last time I checked, when a company receives investment grade status, that's a very good thing. That means that capital is cheaper. People can lend money to them at a cheaper interest rate than previously. And that's also a good thing for the company because it can get added into more funds that require investment grade status. So this allows for more capital flows. It's all around a good thing. Part of my investment thesis on Vici was them achieving investment grade status. Netflix had not had that because of their large amounts of debt, but now they finally achieved it. This is a material positive thing that makes it cheaper to operate the company. But then we move on from this. Netflix is the leading streaming-based service, yada, yada. We're working on building more revenue and expanding margins. The margin expansion is going better than expected. And they say they're now expanding margins to 18 to 20%, and they're going to generate at least $3.5 billion of free cash flow, up from our prior expectation of $3 billion. So let me get this straight. Netflix comes out with earnings. that just the top and bottom line, they match expectation. They beat on their earnings, they miss slightly on their revenue. So basically in line with their expectations. The stock sells off 10%, and they also announced that they're investment grade now, which is materially a positive thing. It lowers your cost of capital. They also announced that their margin expansion is going better than expected. They're raising margins better. And they also announced that they're raising their free cash flow guidance from $3 billion in 2023 to $3.5 billion. Oh, you're generating more cash flows than expected. Sell the stock, sell it as fast as you can, down 10%. That's the reaction from the market. A company announces that they are expected to grow their free cash flow faster than previously anticipated, and the market's reaction is to sell it off as fast as possible. And this is why I've said often that when I'm doing analysis on the quarterly reports of a company, I don't take the market as advice of the performance. You can look at it, but it's so often just dumb. It's incorrect. Investors don't pay attention to actual data going on in the earnings report. Look at this now. That 10% sell-off in, what is this video? 10 minutes long, 5 minutes long? It's gone. It's evaporated. Now it's down 1%. In my opinion, I think the stock should be up 5 or 10%. They raised their free cash flow guidance. They received investment grade status from Moody's. Things are going better than expected for the company. Fundamentally, it's very sound. So just wanted to jump in there and say that sometimes the market's very dumb. As we go through this earnings report season, try not to pay too much attention to the instant reaction from the market on earnings. It's entertaining, it's fun, but it doesn't really say a lot about the fundamentals of the company. To get to the fundamentals, you have to open up the earnings report, read through it, and actually figure out what the company's actually doing. So there's my little impromptu video. I hope you have a great day. See you in the next one.